Running a restaurant is a constant battle against razor-thin margins and rising costs. But what if I told you over 60% of eligible restaurants are leaving tens of thousands of dollars on the table? Are you one of them? This isn't small change. We're talking about refunds exceeding $100,000 and an average of $40,000 annually. And this is not another deduction. It's a dollar-for-dollar reduction of your federal income tax. In the next few minutes, you'll learn what this credit is, why it's so often missed, and how to claim the money you are likely owed. So what is the FICA tip credit? It's a legitimate tax incentive, not a loophole created by Congress back in 1993. As an owner, you pay FICA taxes on all reported tips, even though that money comes from customers. This credit offsets that specific financial burden. Let's be perfectly clear on the math. A $10,000 credit saves you $10,000 in taxes. A $10,000 deduction might only save you $2,000 to $3,000. This opportunity is not just for large corporate chains. Small, independent restaurants and local bars are equally eligible to claim it. For an industry with tight margins, this credit directly boosts your bottom line by returning a portion of your mandatory payroll tax contributions. If it's so powerful, why are over 60% of restaurants missing out? The answer comes down to a few common costly mistakes. The single biggest mistake is assuming it's automatic. It is not. You must proactively file a specific form, IRS Form 8846, with your tax return. Even a good accountant might miss it. This is a specialized credit, and they may be unaware or simply not take the extra step to file it for you. The calculation itself causes confusion. It's based on tips earned above a federal minimum wage that seems stuck in the past, $5.15 an hour. This is not the FLSA tip credit that lets you pay a lower base wage. That's about payroll. This is about your income tax bill. Another error is confusing tips with mandatory service charges. Auto gratuities are wages. Only voluntary tips qualify for this credit. So it's misunderstood. It isn't automatic, and it's easy to overlook. Now let's see what claiming it can actually do for your business. Imagine having an extra $40,000 in cash this year. That money could pay for a new oven or a major marketing push, all without raising a single price. But the opportunity is likely much bigger than that. You haven't just lost this year's credit. You can actually go back in time and claim what you missed. The IRS permits you to amend tax returns for the past 3 years. This can trigger a substantial one-time refund check for taxes you already overpaid. Remember that 60% of restaurants that don't claim it, that means millions of dollars in retroactive refunds are sitting with the IRS waiting to be claimed. The potential is huge, but to secure it, there are a few important details to get right. Let's cover the nuances of the calculation and what you need. To claim this credit, your records must be solid. You need detailed payroll data. Hours worked, tips per employee, and wages paid. Clean data is key. Now back to that strange $5.15 per hour figure. That was the federal minimum wage when the law was last updated in 2007. Congress never changed it. A key detail: for the current year, the credit is non-refundable, meaning it can only zero out your tax bill. The cash refund comes from amending past years. These details, the forms, the look-back period, the old wage rate, are exactly why general accountants often miss this. It requires a specific focus. We've covered the opportunity, the common mistakes, and the critical details. Now, let's put it all together into a clear, strategic picture. You are required to pay taxes on money, tips, that never even touches your bank account. This credit is the congressionally designed remedy for that burden. When you combine the power of a dollar-for-dollar credit with the ability to amend 3 years of past tax returns, you create a massive financial opening. The fact that it's not automatic and often missed by preparers means one thing: the responsibility falls on you, the owner, to ask the right questions. Leaving this money on the table is not just a missed opportunity, it's an active cost. It's the same as turning down a refund for taxes you overpaid. The takeaway is simple. If you have tipped employees, you may be entitled to a substantial tax credit and a significant cash refund from prior years. The first step is a professional review of your payroll data and past tax returns. Ask your accountant, are we claiming the FICA tip credit on Form 8846? Every day you wait, you risk the statute of limitations closing on a prior year's refund. This is your money. It's earned and it's waiting for you. Stop leaving money on the table that belongs to your business. Find out if you qualify for the FICA tip credit today.